My broad thesis here is that we are in a commodities bull market. So that's what I'm running through here. Here's the GSCI. I always say that one backwards if I try and say it too fast. GSCI Commodities Index. This is just the first 4 months of the year, but it rose 23% in those first 4 months. Like it's pretty, and actually more since then. I just have the first 4 months because I have some comparisons and historical looks at previous times that we've had gains like this in the first 4 months of the year. Yes, it's just recovering to its pre-COVID levels, but the pace of the ascent has been standout, right? That is a really impressive ascent for the commodities index. So then the question, of course, is, can that last? And I think to try to answer that question, I want to look at fundamentals, technicals, and history. You know, it's the best we can do, right? On the fundamental side, I mean, I'm talking right now about base metal or commodities as a whole, not even just base metals, commodities as a whole, precious metals, base metals, and other commodities for that index. So obviously I can't talk in detail, but when we come to the metals space, it's pretty safe to say that almost across the board, there is strong demand against weak supply. And that just stems from the way that our sector has been for the last 10 years, with not a lot of investment into new projects, and with, especially through electrification, demand really ramping up. And so that's why, bottom line, copper, silver, nickel, uranium, that's why their prices have been rising so much. Supplies just will not meet demand in the coming years. So, you know, good starting point there. A few more examples. I mean, this is the palladium chart. This is the iron ore chart, right? These things have done, these metals and commodities have made pretty impressive moves in the last year. And it's largely a basic supply demand situation. When we get to the technical side of things, it's a bit mixed right now. I'm going to focus just on copper, gold, and silver because, you know, you can only cover so much ground in one short talk. Right now, the signals are a bit mixed. This is the copper chart. You know, different technical analysts focus on different things. And as I was going through all of those various outlooks yesterday, I basically decided that there are as many up arguments as there are down arguments for the short term, right? But that's okay. And because for me, when the technicals are mixed in the short term, I just step back and look at the fundamentals, which are very bullish in the medium to long term, right? And the technical trends are also bullish medium to long term. So I don't know exactly what copper is going to do next week based on this chart. I mean, does anybody ever? But you know what I mean? Similar actually for gold and silver. So the two charts on the top here are for gold. The two charts below are for silver. Basically, the bulls have it in the short term, but the signals are mixed for various reasons. Again, in the short term, I don't know exactly what's going to happen with these prices. But in the medium and long term, the technical pictures are very supportive for both metals. So, you know, moving quickly, I think it's safe to say that absolutely on a fundamentals side of things, we are well supported for commodities. On the technicals picture, we are well supported in the medium to long term, albeit with a mixed short-term outlook. Now I mentioned, let's look a little bit at history. So, I mean, for commodities to be up 23% in the first 4 months of the year is anomalous, but it has happened before. So what happened in those previous instances when commodities had an extremely strong start to the year? Well, Canaccord did exactly that analysis. They looked at years when commodities were strong through April, and then they averaged out those patterns to see what happened over the rest of the year. They excluded two anomalous years, 2008 and 1982, and the patterns pretty clearly suggests that after a summer breather, which matches that mixed short-term technical outlook, right? A summer breather, sideways, we're not sure what's going to happen through the summer. Commodity prices rose again to add another 9% from May through December, including that summer breather. So history supports the potential for this rally to continue through the year. If we settle down just into the exact moment that we're in, I mean, gold is strong. If you look at the sort of 5-day chart of gold, you might not think that it's a bullish commodity, but all you have to do is step back and look at the 60-day chart of gold, and it's a very strong chart, let alone if you step back and look at the 1 year, the 2 year, the 5 year, they all look really strong. The primary drivers right now are absolutely, inflation talk is absolutely one of them, and we'll get a little bit more of a feel for that, or that conversation will evolve, is perhaps a better way of saying it, this afternoon when the Federal Reserve releases its next round of minutes from its conversations. But nonetheless, there's a lot of focus on inflation, and so that's pushing gold because, of course, inflation pushes real rates into more negative territory. And then there's this concept of commodity catch-up. I was just talking about how commodities have been so strong in the last 6 months to a year, and gold usually tracks metal markets. It usually moves with them, but it hasn't. The somewhat complicated chart on the bottom there shows that gold is lagging right now. But that black arrow on the right that suggests a turnaround and move back up again suggests that gold often lags in its tracking of the metals market a bit, but it does catch up once it turns around. So is a catch up coming as part of the commodities argument? I would suggest that it is, because metals do like to move as a group. It's not just that they like to move as a group. I'm not trying to anthropomorphize metals. It is, of course, because of inflation and growth and all of the fact that similar macroeconomic factors move these things together. I just like to talk about them as people because I spend so much darn time thinking about them that it makes me feel like I don't sit alone at my desk so much. Okay, then if we want to just look at gold, and I'm looking at gold certainly as a proxy for silver. Silver, as all of you will well know, has those dual forces, the industrial side, which is more of the commodities argument that I was just describing, and then the precious side. So let's look a little bit more closely at gold. Negative real rates are the most important bull force for gold. This is a chart of the inflation indexed 10-year treasury. So it's a good proxy for real rates. A lot of people look at real rates based on the 10-year treasury. And this is just the history over what I would call the gold market so far. So the beginning in 2016, real rates started falling, the gold bull market started. Then real rates were gaining for a couple of years, and that hindered the gold market until 2019 when they started falling again. And so in 2019, falling rates were actually setting us up very nicely for a precious metals market on their own. And then COVID hit, which wasn't actually a bad thing for the gold market, because wham, bam, central banks around the world, of course, slammed interest rates to zero, which pushed real rates into negative territory. So they were suddenly very negative, and based on the words that come out of central bankers around the world, again, we will get a little bit of an update on the American group thereof this afternoon, but everybody keeps saying that they are going to hold rates negative. I mean, the ECB just kept their rates at negative 0.5 in their meeting just last week. And the Federal Reserve certainly is suggesting that they are going to keep rates at zero for the time being. They continue to be confident that inflation is transitory. I'll get to that in a moment. But the point is that real rates are negative. The chart on the bottom here shows gold inverted and the 10-year real yield. And I just put that chart in there. I love this chart because it shows how correlated these things are. This is why negative real rates are this shows how negative real rates are the most important bull force for gold. They move together. So then, of course, the question is, what's ahead for real rates? I do not think that the Federal Reserve is going to raise rates in the near term. It would be a significant turnaround for them to suddenly say, oh no, inflation's real, so we're going to raise rates. They've been very strong on saying that inflation is transitory, so I don't think that a rate hike is coming soon. So if rates stay at zero, what's ahead for inflation? Because real rates are interest rates minus inflation. That brings up the question, will inflation stick? The Fed, as I was just saying, has been saying over and over and over again that inflation will be transitory. But I do think that there are some arguments for that make sense. The factors that are contributing most to inflation, some of them are transitory. Certainly, if you look at year over year inflation numbers, I think that those are a little bit overstated. They're overstating the effect right now because of that base impact from where we were a year ago in the depths of COVID chaos. But I also think that there's a pretty good list of reasons that inflation will stick. I mean, some of the COVID-based supply chain disruptions that we're facing are likely to last for a while. I mean, my husband wanted to buy a new cassette for his mountain bike last night and he could not find it. And that's largely a COVID fallout. Mountain bike parts come mostly out of Japan and Taiwan, and things are not functioning there the way that they need to. That's just one example. There's real supply chain issues from COVID that are going to stick, and inflation is stems partly from that. Then you can look at just some data. I mean, surging transportation costs, land and sea. Manufacturers don't just absorb that. That gets passed along the pricing chain. Of course, lumber is the standout example on the commodity side. The prices have eased a little bit, but a year ago, you could build 10 single family units for $50K worth of lumber, and now you can build 2. Like that's a crazy change. Then there's, of course, the ongoing massive fiscal spending, which is very much still true, and the explosion in money supply. There are some aspects of inflation that are transitory. I'm not trying to suggest that everything is going to stick, but I do think that a lot of aspects of inflation are here for a while. And the fact that they're here, I mean, I don't think anybody's going to argue that. We had, in April, we had a 0.8% month-over-month gain, and then we had 0.6% in May. Those were both, the 0.8 was way above expectations. The 0.6 was slightly above expectations. We have things like small business owners, a third of them raising prices, that being the highest proportion to answer such in a survey in 40 years. There are clear signs that inflation is here. COVID has given, if you want to call it, an excuse for prices to rise. So it's easier for retailers to raise prices because there's this sort of obvious finger to point. There is a little bit of a caveat that wages are not yet rising, which might hurt the inflation argument a bit. But at the end of the day, inflation's here, and inflation really matters for those of us who invest in precious metals. I really like this chart. It looks like a bit of a kid's painting until you focus in on it a little more closely, but it's a Scotiabank analysis, which shows how when inflation is less than 3%, sort of 2.5% or less, then inflation and gold are not correlated. The correlation is all over the map there, right? From negative 0.3 to positive 0.3, whatever. That's not a correlation. As soon as inflation ticks above 3%, the correlation between gold and inflation suddenly gets very clear. So if we are in the scenario that I think we're in, where inflation is here and it's real, it doesn't need to be insane. It just needs to be here and real in about a 3% level. Then the two rise together. And I do think that is a key thing to watch. I think it's going to be a very significant force going forward here. So about those real rates. This is the 10-year Treasury yield. It, of course, the other factor here is, yes, the Federal Reserve has kept interest rates at 0, but people don't think about real rates relative to, the Federal Reserve's interest rates. They think about real rates relative to the 5-year Treasury, the 10-year Treasury. The 10-year is the most common. And it went on a run. The yield there, ran from 0.5 as high as 1.7 between August and April. That's an insane move for something that's supposed to be like the stable stalwart of the economic world. It has eased some, as the chart here shows, but it could still gain more. I mean, if we have economic growth and that creates inflation, inflation pushes yields higher. Similarly, massive deficits require the government to issue lots of notes, and an abundance of notes also pushes yields higher. So I'm not standing here saying the 10-year Treasury yield is not going to go higher, but I am saying that if inflation stays above 2.5%, which I think is a pretty safe statement to make, real rates will remain negative, right? So I don't lay awake at night stressing about whether the Federal Reserve is going to boost interest rates by 1/4 of a point. I don't lay awake at night wondering about the delicate balance between the 10-year yield and inflation. I think it's pretty clear that there's going to be enough inflation that sticks enough that it will overcome the 10-year yield, even if it gains some. That's just the scenario we're in, and that means real rates are going to stay negative. And this just reiterates what I was saying there. Gold and real rates are best friends. They move together. Right now, the real yield has moved ahead of gold. That suggests more upside for gold in the near term. And I mean, there's a chart there on the bottom that is from Canaccord, which suggests that a real yield on the 10-year of negative 1.5, which is potentially the direction in which we're heading, would mean gold at better than $2,000 an ounce. Now, you know, lines on charts are what they are, but I do think that these correlations are very important. Now, it's one thing to believe in the technical picture for gold and silver and commodities and all of those things. It's another thing for that to actually attract investors. It seems like it shouldn't be a different thing, but it is. Part of it is because precious metals just have their naysayers. There's people who just aren't interested in these things. There's also the simple fact that the broad market funds have handed out money for years, that tech stocks and crypto and biotech are so splashy and exciting. And that commodities have sort of stumbled for a few years, right? Maybe gone forward and then stepped back, and in uncertainty, it's been hard with all of those factors for metals to attract sustained attention. But I do really believe that we're at a point right now where we have a multi-metal bull market fueled by electrification and green energy, clearly very important on the silver scene, but for lots of metals, by inflation, by growth, by negative real rates, and by the fact that mining companies are printing money. They stand out across equities for their balance sheets and their dividends. When you have all of those forces working together, that's a multi-metal market, and it's multi-metal markets that build momentum. So even though investor interest right now still feels perhaps a bit muted, I do think that that's going to change soon. And over the rest of this year, I really think that we're going to get that sense of generalists being unable to deny the opportunity, the upside, the low risk gains that are apparent in this multi-metal bull market. This chart, I'm almost done here, but this is an example of how miners stand out across equities for their balance sheets and their free cash and their dividend yields. I mean, the chart that I have on the upper left here shows the dividend yield history for gold and outlook for gold producers. Now, I've added some yellow lines in there because the chart was a few years old. And guess what? The average dividend yield of the S&P 500 is down to 1.4, and we are looking at gold majors giving out 2.3. And those trends are going to continue to diverge. And so things like that. And then there's the bar chart there shows precious metal miners' free cash flow versus dividends. Precious metal miners have, it doesn't, not even actually miners, a lot of them have pegged their dividends to free cash flow. And it's like free cash flow is through the roof. Look at those blue lines. And so you don't have to be a metals lover. You don't have to be a silver buff. You don't have to be any of those things to see the value in metals right now and in mining companies. And I think that's a really important factor in fueling this bull market. You just have to be a number cruncher to see that these stocks make sense. So I really think that that's going to help fuel the market. I do think we are in, if I haven't said it over and over enough yet, I do really think that we are in a major metals bull market. Corrections happen, right? Short-term uncertainty is just part of any market. But when we have this level of demand for metals, from growth, from stimulus, from infrastructure plans, when we have that plus inflation, when we have that on top of insufficient supply, the ingredients are all in place for a major metals bull market. I mean, right? Copper is strong and people are expecting copper to get stronger from here. Uranium has to go at some point. Battery needs alone are going to double nickel demand by 2030. That statement always catches me a bit off guard. Nickel's a steel thing, right? Well, no, in the next 10 years, battery demand is going to double nickel demand, right? This is a paradigm shift, and it matters in the metals world. It's going to fuel a really significant bull market. So I really think that this is where we're at, and that's all I'm going to do for today. These are I don't think in this audience that I need to talk a lot about what I do as a business. I publish 2 newsletters, and my partner in crime, Peter Kraut, who will take the stage here twice today, publishes another 2 newsletters. Importantly, we don't take money from companies for what we say. We just write about what we're buying and selling.